All right. Good morning, everybody. Welcome. Thanks for being on. Good morning, Sherry, Nettie, Leo, Brendan, Sue. Good morning on StreamYard. Everybody on Facebook as well. Good morning. Um, so appreciate you all being on. Looks like we're still trying to go live on Facebook. Give me just 1 minute while we get that going. But yeah, thanks everybody for being on. We got a company meeting today. A lot of good information I want to get through and cover. It looks like we are live on Facebook now as well. Awesome. Perfect. All right. Good morning, everybody. Welcome. So, company meeting. Good morning. Hope you're doing well. Hope you can hear me. Drop a comment if you can hear me okay. Appreciate it. But thank you all again for being on. Let's dive in. So, we do these company, Christy, good morning. We do these company meetings once a month and got a lot of good content I want to get through. So let's get it going. First thing I want to do is congratulate all of our top 10 agents for the month of July. It was a fantastic month of July. A really strong month for us as a company. We're continuing to do really, really well in the rankings. And our top 10, Angela, Kathy, Janie, Suzanne, Jessica, David, Mona, Mary, Latoya, and Chandra taking out the top 10. So again, fantastic month. I know this list is getting more challenging to get on as well as we continue to grow. So I want to thank and congratulate everybody on the top 10 for the month of July. August is looking even better. So you all are doing a fantastic job getting homes sold. And August is really shaping up to be maybe our best month of the year. We shall see. So Sheila, good morning. Sarah, good morning. So yes, again, congratulations to all of the top 10. I wanted to acknowledge our growth share earners for July as well. If you don't know, or you're unaware, we offer with NettWork Global, we offer what we call growth share. And basically what that is we give away or give back, I shouldn't say give away, we give back 20% of our revenue, top line, just direct revenue directly back to the agents who help us grow the company. So that means when you join NettWork Global, you most likely named a sponsor agent. And then if you get agents to join NettWork Global as well, you get, they would name you as their sponsor. And basically out of our $485 fee, we give back $100 of that in the form of growth share per closing to the sponsor agent. So you can see in the month of July, Jessica was the top growth share earner. She received $900. Sonia, 600, 500, 300, 200, it's a bunch of 100s in there as well. So if you're not getting a piece of that, talk it up, talk to your friends. If you're happy with NettWork Global, make sure to please continue to spread the word, help us grow, and you can get some growth share as well. It's a good little additional revenue pillar. Could be a car payment, who knows, each month. So again, thank you all for being a part of that. And congrats to everybody who had a fantastic growth share month as well. Next thing I want to talk about real quick is our upcoming trainings we have. So we've got a pretty full training calendar. The first thing we do is we do offer a NettWork Global mentorship program. And that is, get that out of there. There we go. So NettWork Global mentorship program, that's every Wednesday at 6 p.m. If you've been on that, we've done 2 of those so far at 6 p.m. Doesn't cost anything to be a part of that. Make sure you jump on 6 p.m. We text out Zoom links every week for that. And we're basically just combing through the basics of how to be a really good realtor, what we need to do step by step to get our business really going, to have a sustainable business, because it's one thing to have a really good year in real estate. It's another thing to have a good decade in real estate. And that's what we want, is everybody in our company to continue to have a solid business year after year after year after year. And the way we do that is simply by applying the basic principles and staying consistent with the things that we're supposed to do day in and day out to ensure we really have a bulletproof business and a business that's irrelevant or that's not affected by the economy. You want to build a business where the economy is irrelevant. And what I mean by that is that if I'm doing my activities that I'm supposed to be doing every single day consistently, well, I know that results will continue to show up for me and the market really becomes irrelevant. And I often use kind of like '08 as an example. In 2008, we went from 2000, I got in the business in '05, which was considered a fantastic market. Interest rates were 6.5%. Inventory, I think, was at like 6 to 7 months. We were kind of in a balance to slightly more of a buyer's market at that point in time, but that was considered a really good market. And then '08 came, and what happened was half of our industry over time quit. And half of our industry quit, not because the market was terrible. They use that as an excuse because they're saying the market was terrible, but all it was the market was different. It was just different than it was the previous 3, 4, 5 years. And so for the agents that adjusted and adapted and got really good at working with investors and were finding homes for first-time home buyers, because if you think about it, pricing did fall quite a bit. So it was a great time for home buyers to purchase homes. But if you got into foreclosures and short sales, there's an abundant amount of opportunity. So that's a lot of what we talk through with the mentorship program, is really how to frame your mindset, and then also to succeed in any market, but as well as that, how to build a sustainable business in any market, not just a buyer's market or not just a seller's market or not just a balanced market, but any market, how to have a great business. So tune into that on Wednesdays. Next thing, this Thursday, we're doing listing skills training, mastering the art of the perfect listing. So tune into that. That's at 9:30 this Thursday. It will be on StreamYard here, as well as live streamed into the Facebook group. Also, Maris training series. If you haven't been a part of these yet, they've been pretty good. Sorry, I got a little cold going on here or something, but Maris training series with Elizabeth Stodley. She works for the St. Louis Association. She's offering these trainings. The next one is also Thursday, the 29th at 11. She'll be covering market stats, and then September 19th going over realist. So make sure you tune into those. Those are not recorded, unfortunately, because those are not us putting those on. That's a third party doing those trainings for us. So just make sure you tune into those, though, and they've been really good. So that's this Thursday. So we do have 2 trainings Thursday. We've got the listing training at 9:30, and then this at 11. So make sure you jump on that. Also, the economic update with the NAR chief economist, Lawrence Young. So again, this is a mastermind group I'm a part of. I did post this registration link in Facebook, in NettWork Global Agents Facebook group this morning. Make sure to sign up for that. Chances are the available seats, if you will, to be a part of that, or the available slots of number of people that can join that will fill up. So make sure you click on that link. It's in Facebook. Leo, if you don't mind too, if you could grab that link, I posted it just a little bit ago, and drop it in the comments section, and people can quickly click on that. But he's going to be talking about the economy. This is good. I know for some people the economy stuff's kind of boring, but I think as a real estate agent, being able to not be an economist, but being able to know enough to talk about it intelligently is important when we're talking about it with our clients, with our friends, with our family, with our SOI. I think it's important. So I think this is going to be a really good update. And again, that's Thursday, the 29th, which is next week, Thursday at 12 p.m. So jump on that. We'll get a link in there for everybody to sign up. Net worth training series. We're going to start diving into this again. This is October 10th. We're going to start this. It's going to be a 4-week series. We're going to talk about building wealth. What I've always said is that a real estate agent, it's the only industry I know where you can go to school for a week, put the school on a credit card, pass the C- or better, and make more money than a doctor. It's a pretty cool industry. And the challenge is we can become high income earners as a real estate agent. We can make a lot of money. You can make $400, $500, $600, $700, $1 million a year as a real estate agent. And what's almost just as important as creating that income is, what are we doing with that income after we create it? What are we doing? Are we immediately increasing our lifestyle and taking on higher car payments and bigger house payments and nicer vacations? Or are we investing that money into things that pay us passively that can generate wealth for us? Are we buying real estate? Are we cost segregating the real estate that we're buying to offset our income tax, to basically zero base our income tax and not pay income tax anymore? Are we doing those things to build wealth? Are we maxing out our IRAs? Are we maxing out our simplified employee pensions? There are lots of ways to create wealth, and lots of simple ways to create wealth, but it requires a little bit of knowledge, and it requires a plan, and then it requires consistently sticking to that plan. So tune in for that as well. That's going to be kicking off October 10th. Again, it'll be a 4-week, most likely 4-week. We might go 5, but probably can get it all done in 4. So jump on that. The last thing too that we have here from a training perspective is the Success Conference. This is in person. So this is an in-person event. Make sure you jump in on this. This is going to be in person at the St. Louis Association of Realtors. It is October 1st. It's going to start. We'll do a little meet and greet type thing at 9 a.m. It's going to run till about 12:30 at the St. Louis Association. We're going to be covering business planning, kind of goal setting, mindset, all kinds of things, different tactics to really help you set your business up for success moving into 2025. So that's Tuesday, October 1st. Make sure you sign up for that too. Seats are limited. I think we have like 20 seats left or something like that. So we have limited space on that, but I want to make sure everybody can attend that. So make sure you jump on that. Leo, if you don't mind dropping the link on that too, I would appreciate it. But make sure you sign up for that. That's going to be a really good day. There we go. Link's been dropped in. So that's coming up. It's I know we're just in August, but we're getting close to September. It's not that far away. I think we're about 6 weeks away or something like that. So jump into that as well. All right, let's dive into some stuff, some content. So the big hot topic that's been the hot topic for a while now is mortgage interest rates. Are rates going to drop? So if you were watching the Fed decision a couple of weeks ago, Fed decision on July 31st, in support of its goals, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. That's the Fed rate. Typically, a mortgage interest rate is about 1.5% to 2%, give or take, higher than whatever the federal fund rate is. So that's where we're sitting at. What's everybody seeing in rates? Drop it in the comments, like in the sixes, high sixes, maybe still 7. That's kind of what we're seeing right now for interest rates. But let's talk through this real quick. So the chief economist from Moody's Analytics said the Federal Reserve stuck to script, holding monetary policy unchanged, but strongly suggesting a rate cut is likely in September. And if you recall, Rory Leach with USA Mortgage, he's an in-house lender for us. He posted something last week talking about the high probability of rate cuts starting to happen in September. But we're going to get into a little bit and see what does that rate cut look like. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. Global investors are cheered by this. Stocks are up and a lot of bond yields are down. We saw what happened with the stock market there recently as well, right? As they should be. The economy is set to soft land, so they think. Now, mortgage rates. Chief economist of Freddie Mac. Mortgage rates declined to their lowest level since early February. So we did see rates start to come down some. Is everyone seeing that with your clients? Expectations of a Fed rate coupled with signs of cooling inflation bode well for the market, but apprehension in consumer confidence may prevent an immediate uptick as affordability challenges remain top of mind. Despite this, a recent moderation in home price growth and increase in housing inventory are a welcoming sign for potential home buyers. So we're starting to see rates decline just a little bit. Now, this one too, the unemployment rate rose by 0.2% to 4.3 in July. And the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year earlier when jobless rate was 3.5% and the number of unemployed people was 5.9. So there's more unemployed people. Now, keep in mind from a labor statistics perspective, unemployed people are people that can work and actively looking for a job. So if they're not actively looking for a job, they're not factored into this number. So just keep that in mind. Let's look at our unemployment. The average is 5.7. So we're actually below, statistically, the average of 5.7% from unemployment. We're at 4.3. So just something to keep in mind. Again, do we need to be economists? No. Is it good to know this stuff? I think so. That's why we cover it. So unemployment has crept up a little bit, but it is below the average of 5.7%. And here's Lawrence. Here's our boy, Lawrence Young, that's going to be speaking with us next week. Mortgage rates are plunging on the news of weak job growth and rising unemployment. So because there's weak job growth and rising unemployment, they're saying that mortgage rates, or at least Lawrence is saying that mortgage rates are plunging. So starting to go. So it's going to be interesting. I'm really kind of curious to listen to what he has to say next week. So again, make sure you sign up for that. Leo dropped it in the comments. I think it's going to be a really good conversation. I really do. Let's look at this. Mortgage rates dip to the lowest level since February. So 6.4 was the average mortgage rate last week. So 6.4. Anybody lock clients in south of that, less than 6.4? Anybody with your buyers, did you get anybody locked in on a 30-year fixed for under 6.4% recently? Or has anybody seen higher? Love to know. Drop it in the comments. But that's where we're seeing rates. Now, look at this too. In May, look where we were at. 7.52 is the average. So we're almost 1% less, 1 percentage point less. And one statistic or one little fact I want you to keep in mind and this is a good thing to talk to your clients about, is that for every 1% in interest rate rises, then that means they lose 10% buying power. So keep that in mind. For every 1% in interest rate rises, a buyer loses 10% buying power, and it also works in reverse. For every 1% a drop in a mortgage interest rate, a buyer gains 10% buying power. So if I'm looking at a $500,000 house and a rate drops 1%, I potentially picked up $50,000 in more buying power. For every 1%, you gain or lose 10%. If mortgage rates go up 1%, I lose 10% buying power. If mortgage rates drop 1%, I gain 10% buying power. So keep that in mind. David said I had a buyer lock in with a buy down of 5.3%. Awesome. Yeah, that's good. 5.3% buy down. So if you're not familiar with what a buy down is you can use seller paid closing costs and buy down your mortgage rate for a period of time, 12 months, 2 years, 3 years, depends if it's a 2-1, 3-3-1, whatever the case may be, 3-2-1. You can utilize that to do a buy down. So talk to your lenders about buy down opportunities. I'm sure most people now are familiar with that, especially when rates were up in like the 7s and mid 7s and high 7s. But keep that in mind, 5.3% with the buy down. Heather says we buyer locked in at 6.375. So yeah, just below that. Now, something I want you to keep in mind too, does everybody know what the historical average is for a mortgage interest rate? The historical average for the life of the mortgage is 8%. So 8%. So we are below and have been below what is historically the average mortgage interest rate. That's 8%. So another number that's important to keep in mind when we're talking to our clients, because a lot of our clients, not so much now, but a year ago and 2 years ago, or especially a year ago, we're saying, well, we want to wait for rates to drop, anticipating that rates were going to get back to 3%, 4%, 2.5%. That's not probably the case. It's not reality. And we'll talk through that here a little bit more. Let's see, we've got, David says, I got the seller to pay 6%. Let's look at this one. I got the seller to pay 6% on a 400K house towards the buyer's buy down. These deals are out there, definitely. So there we go. You got 6% closing costs toward the buyer's buy down. So it's a lot. 6% of 400 grand is what, 24 grand? Yeah, it's a lot. So good job, David. That's awesome. Deals are definitely out there, especially for houses that are sitting on the market a little bit. There are deals to be had, that's for sure. Let's look at our demand based on rate environment. So we see that when we were, earlier this year at 7.5, the buyer demand is weak. Now, as we move into that 6.4 right now, from an average perspective, the buyer demand is getting stronger. So the demand is that if we're sub 6%, the demand is really, really strong. So we're moving into good territory from a buyer demand perspective. We're moving into out of like what I would say weak, where we've been earlier this year in what we call weak demand, into limited. We're now in the good section and probably trending toward very strong, or not very, but strong buyer demand moving into the end of the year. So keep that in mind as well for your buyers that are on the fence right now, qualified, that can't afford to buy a home, that are maybe just sitting on the fence waiting for lower rates. Maybe take a picture of this and show them that if we get to sub 6%, which is possible by the end of the year, they could be competing with a lot larger buyer pool. So just something to keep in mind there. If rates continue to trend down, that means more buyers are going to come into the market, which means there's going to be more competition. So if you have people that are qualified right now, it might not be a bad idea to have a conversation with them and get them out looking today rather than waiting until after the holidays or after the first of the year, or all of those seasonal objections that are going to come up. Because as we trend down, which is a good probability that we'll probably be into this green strong area before the end of the year, potentially. So good idea. Screenshot this. I can send it to you if you want it. But I would get this out to your clients and say, let's get out there and start looking now. Let's not wait until after the first of the year. So the drop in mortgage rates, this is just going to show us too the difference in monthly payment. So in April of this year, if I was buying a $500,000 house at 7.52% in April of this year, my payment would be $3,502.92. That's principal and interest. That's not factoring in my my escrows and my homeowners and taxes and things like that. But 3502, the difference now, so look at the difference there. The difference now on 500,000 at 6.4% now is $3,127.53. The difference being $375. The difference over the life of the loan is $135,140. So pretty substantial. So we're seeing already with mortgage rates dropped, there is substantial savings and significantly more buying power for your home buyers. Again, this is all good information, in my opinion, to pass along. But even look here at the bottom, it says total monthly payment may vary based on loan, property taxes, insurance, HOA dues, so on and so forth. So good info there. Let's look at our boy Lawrence again. There is a large pent-up stored demand that could be released into the marketplace when conditions improve, lower mortgage rates, and more inventory. Inventory is finally turning up about 15%. That's nationally. They're saying inventory is up about 15%, and that likely is an early leading indicator that we may finally see more home sales as conditions improve. So we're seeing inventory trend up right now, and we're starting to see rates come down. Could look really good for us moving into the end of the year, into 2025 as well. So listings have trended generally upward of late, suggesting to us that a rising number of current homeowners can no longer put off moving. So keep that in mind too. I've always said this, that residential real estate is a fantastic industry to be in because people buy and sell homes not based on what I will say financial sense, if that makes sense. People are buying homes based on emotion, based on their needs, based on I'm getting relocated, I have to move, based on I want to get closer to my family, based on I want to get closer to my grandkids. I want to downsize and get into one level. I don't want to deal with stairs anymore. My yard is too big. I want to get into something more manageable. I want to move into a condo. So keep that in mind. And it's saying this here is just that listings have trended generally upward of late, suggesting that a rising number of current homeowners can no longer put off moving. So the people that have those needs, that want to get closer to family, that want to downsize, that want to get into not having stairs or yard work or less maintenance or whatever the case may be, are no longer choosing to put that off. And that's where we are seeing more inventory starting to hit the market. That's one of the beauties of residential real estate is that one, people always need a place to live. And two, interest rates are irrelevant in a lot of ways. If somebody can afford it, and the 90s will attest to this, right? We were in double-digit interest rates in the 90s. And I think before that, like high double digits, 17, 18, 20%, people still bought homes and still sold homes. So interest rates are really irrelevant in a lot of ways, but it does help us to have lower rates. We all know that. Now, this is what I was alluding to earlier. The hopes for lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. I think this is super important. I've been talking about this for a while as well. Mortgage rates are 7% now, give or take 6.5%. And the best we may be able to hope for over the next year is 5.5 to 6. So again, educate your clients because they're hearing that rates might drop in September. They're hearing that rates may continue to drop through the end of the year. They may be hoping for a 3% mortgage, which probably isn't going to happen. The probability is high that we won't see 3% for a very long time, if ever, in our lifetime. So we need to gauge and educate our clients that if they're sitting on the fence and they're looking at a mortgage interest rate calculator or a mortgage calculator and they're consistently typing in 3% or 4%, and they're waiting for that to happen because that's where they feel comfortable with their monthly payment, we have to have a realistic conversation with them and let them know that that's probably not going to happen. We might see the 5s this year, potentially, and into 2025, but the likelihood of seeing 4s and 3s and 2.5s is very, very small. So I think it's important to have these conversations with our clients. Goldman. I like Goldman. We've tracked Goldman data, Goldman Sachs, for quite a while. And in this mastermind group I'm in too, they come speak a lot on the economy to our group. And so for the last 3 to 4 years, we've kind of consistently tracked Goldman Sachs data, and they're generally pretty spot on with their predictions. So it's kind of impressive, at least since I've been a part of it and listening to their and kind of analyzing the data they put out. They're pretty accurate. So I like looking at Goldman data because I feel it's pretty spot on. But anyway, they're saying we now expect consecutive 25 basis point rate cuts in September, November, and December. The slowdown in job growth in July, in the July report, likely overstates that the decline in the underlying trend. But if the August unemployment report is also weak, then a 50-point basis cut would become likely. So they're saying, keep that in mind. They're saying that we'll most likely see 25-point cuts, basis points. It's a 1/4%, a 1/4%. So if we're at, just call it 6.5 right now, in September we could be at 6.25. In November we could be at 6, and potentially December we could be at 5.75. It's potential, or slightly better depending on the August employment report. So if that's weak, we could see a 1/2 point cut. So again, take this data, talk to your clients about it, let them know it's possible by the end of the year we could see, high 5% interest rates, but we're probably not going to see 4%. We're probably not going to see 3. We're probably not going to see sub 3. So again, keep that in mind, but also just take a picture of this slide as well. Send it to your clients, share it with your clients. So let's talk about home prices. I think that's enough on rates. If you have questions on rates as well, drop it in, but we are seeing rates trend down. And again, based on the Goldman data here, we're seeing that rates could be in the high 5s by the end of the year, potentially. We'll see what happens. Let's look at home prices real quick. Expert forecasts lean towards a moderation in home price growth over the next 5 years. This translates to a slower and more sustainable pace of appreciation compared to the breakneck speed witnessed in recent years, rather than a free fall in prices. So we know that in the state of Missouri, over the last 5 years, we have seen about 58. Now, this is not counting this year, but prior to 2024, we saw about 58% appreciation across our state. That's a lot. That is a massive amount of appreciation in a 5-year period. That's north of 10% annual appreciation. That's big. For Missouri, that's kind of unheard of, but that's been across the country as well. We've seen massive amounts of appreciation in pricing. What they're saying now is that we're going to begin to go back to what we'll call more normal levels of appreciation, which are more sustainable, not these massive, 10, 11, 12% appreciations. We're going back to like the 3 and 4%, which is a normal price appreciation level here locally. Again, let's look at the average here. This is our 2024 home price forecast, where they feel we will end through the end of the year. Again, check Goldman. I like Goldman here. If you look at the average, you have Fannie Mae, Mortgage Bankers of America, HPS, Goldman Sachs, NAR, Zillow, and Freddie Mac. Goldman saying 3.8. The average of all 7, 3.1. We're probably going to be somewhere between 3 and 4% appreciation this year for home price appreciation, which is pretty normal. So for everybody sitting on the sidelines, if you have those clients that are still talking about this crash, and I don't hear this near as much as I used to, but for a while, everyone was like, we're going to wait for the market to crash. We're going to wait for the market to crash, wait for all these foreclosures. I don't have this slide up today, but I show it pretty often in these monthly meetings. But the number of defaults, people in home default, is still at a record low. It's so far below the number of defaults in 08, 09, 10, 11, 12. We're like, if the number was here in those years, we're way down here. So the number of defaults is super low. So this market crash that everyone was hoping for will not happen, not anytime soon. So again, educate your clients that home prices will most likely continue to appreciate. So if you're waiting for lower interest rates to get into the 4s, or you're waiting for this market crash, you are going to potentially miss out on a lot of appreciation. If I get 4% appreciation on my home every year for the next 10 years, that means my home is worth 40% more. If I was sitting on the sidelines waiting, I'm potentially losing out on 40% appreciation over the next decade. Why do it? Let's get into the market now. So educate your clients. Let's look at home pricing forecast for 2025. So here are the predictions for 2025. Goldman saying 4.4. They think we're going to have a strong 2025. They're actually the most optimistic of all of them. Wells Fargo 4.3, Mortgage Bankers 3.3, and then so on. It just cruises down. We're looking at 2025 home prices 2.7% for an average of all. Again, I would lean toward paying attention to Goldman Sachs numbers, 4.4. So if I continue to get, let's just say 4% this year, and I get 4 to 4.5% next year, well, I've just gained 8% equity in my home. Depending on the price of the home, it could be a substantial amount of equity. So keep that in mind. educate your clients as well, pass this on to them, that we're going to continue to see most likely appreciation in homes, not depreciation. So, co-founder of Resi Club, even if the average national home price forecast for 2025 is correct, it's possible that some regional housing markets could see mild home price declines, while some markets could still see elevated appreciation. That has been, after all, the case this year. Of course, this is something to keep in mind as well. Real estate is very local. We know that. We know that a market in St. Louis is not the same market in Malibu, California. We know that real estate is hyper local. And we're looking at numbers right now from a national perspective. And a lot of the numbers we're looking at right now do apply to what we're seeing here locally. So of course, things could change. Of course, real estate in markets is different. Real estate market in Missouri is different from New York, or it's different from Iowa. It's different from Nebraska, right? Like, we know that is hyper local, of course. And we're still seeing appreciation continue to climb with rates coming down. While housing affordability is low for potential first-time home buyers, slowing price appreciation and lower mortgage rates could help. So the dream of home ownership isn't boarded up just yet. I would agree with that as well. We know that housing for first-time home buyers is expensive. We know that the days of the first-time starter home in St. Peter's for $110,000, the 3-bed, 2-bath, $110,000 starter home is now probably $250,000. We know that because the last 5 years we've had 50% appreciation in homes. It's a lot. So we know that, but what they're saying is that with more homes beginning to hit the market and the slowing of price appreciation and lower mortgage rates starting to slowly come down, it's still possible to get into a home. So don't count out your first-time home buyers. I want to look at this real quick: equity and capital gains. So check this out. This is for your people. Look at 2000, and let's look at our the orange line. That is the number of mortgage liability, meaning how much people owe on their homes in the trillions, right? And then in the blue line, that's our owner's equity, and the green line is the real estate value. So if you have people that have been in their home, say from 2000, they are most likely sitting on a mountain of equity. The difference here, I've got $45.8 trillion in real estate value with owner's equity, with liabilities, meaning what people owe, at 13 trillion. That gives us an equity of almost $34 trillion in equity. So homeowners, especially if they've been in their homes for a long time, are sitting on a ton of potential equity. So keep that in mind. And you can see too, like look later in the graph here, you can see where the pricing, right about 2020, we're at a steady climb here, and then it really started to kind of move up. Those were those years over the last 3 or 4 years where pricing has gone through the roof. But keep that in mind. We have a lot of people sitting on a lot of equity. So some things we need to be educating our clients on are this. One is, so look at Realtor.com. They said for decades, few homes appreciated enough in value between purchase and the sale to exceed the $500,000 exemption cap. We're talking about capital gains here. So, but a recent report from CoreLogic found that last year, 229,600 homes sold in the U.S., or 7.9% of all transactions, had gross capital gains above $500,000, potentially triggering the tax liability. That's up from an annual share of 1.3% 20 years ago. So what this is saying is that because people have so much more equity in their homes now, that capital gains cap, which is $500,000, let me go back here. It's $250,000 for an individual or $500,000 for a married couple. Some people are exceeding that now and having to pay capital gains. So it's not as relevant here in Missouri, but keep that in mind. If you have clients sitting on tons of equity, they may not fall into that capital gains exemption. However, everyone always says, "Oh, we don't have to pay capital gains on our personal homes." Well, it caps at $500,000. So if they're getting more than $500,000 in gain, they could potentially have to pay capital gains on that. So I wanted to make you aware of this because this is something that could become a real scenario, not for the majority, but for some people, some of your clientele, this could become a reality. So I think it's important to know about it, to keep it top of mind for when you're talking with people. So look here, more homeowners paying capital gains taxes due to strong price growth. So the annual percent of home sales with gross capital gains above $500,000, last year was 8.1, this year is 7.9, kind of pretty flat with last year. But look in the early 2000s, 1.3. So because the equity is growing, people are having to potentially pay capital gains now. And we need to educate our clients on this, especially if we're dealing with, upper tier price points. We need to keep them aware of that. So for most homeowners, the capital gains exclusion, which allows you to pocket the first $250,000 or $500,000 if you're married in gains on the sale of your home without having to pay taxes on them, means that you are not likely to pay taxes on the proceeds from your home. But homeowners who have lived in their home for a long time or have seen substantial home gains should be aware of the potential impact. So just keep that in mind. If you're going on listing appointments with people and they've lived in their homes for a long time, we need to make them aware that if they stand to gain over $500,000, they could be subject to capital gains tax. So again, make them aware. Again, not a huge issue. Like even you can see on this graph here, Missouri, insufficient data. Of course, California, right? 28.8%. Yeah, no doubt. Right? Parts of the coast, Washington, same thing, 15%. So in Missouri, we're not as worried about it, but I do think it's still important to know about this stuff. And that's all the reason I bring it up, just because to make you aware when you're talking with your clients. If you're at a listing, let's just say you're at a $2 million listing right now and they've lived there for a long time, they could be subject to it, right? Maybe they paid $800,000 for that house. They could potentially be subject to it. So just keep that in mind. I think it's important. Last thing here too is navigating the tax rules of selling real estate or investment property can be complex. Long or short-term capital gains will apply upon sale depending on how long you've owned the house, but there's also ways to minimize or defer taxes on these types of properties. Consider speaking with a tax advisor or financial advisor to learn more. Of course, we know the 1031. So if these are investment properties, 1031 exchange, or just any property for that matter, you don't need to become an expert, but I would go, if you're not familiar with what a 1031 exchange is, go Google it today. Go Google 1031 tax exchange and just become familiar with it. You can talk to title companies about this. You can talk to CPAs about this. You can talk to financial advisors about it. You can just do Google searches on it, read books on it, and become pretty proficient in it. But learn about 1031s, because if you're working with investors, you should know what they are. But this is just and most people on this call, I'm sure, have heard of this. But a 1031 is a way to defer tax. I can offset, I can sell my property. There we go. Leo just dropped it in an Investopedia link. Go ahead and click it and read about it. But simple way to just, again, become more knowledgeable. And it leads to my last slide here there's a cool quote by Jim Rohn. It says, "Don't wish it were easier, wish you were better. Don't wish for fewer problems, wish for more skills. Don't wish for less change, wish for more wisdom." And I think this quote really relates well to everything going on in our industry right now. We've seen some changes. We've seen a lot of agents that haven't taken the time to educate themselves on the changes. I still see it in these Facebook groups. It blows my mind. But these real estate Facebook groups, people still post, now that buyer agents can't get paid compensation, what's everybody doing? Like, where have they been for the last 6 months, right? Because they haven't taken the time to educate themselves. So instead of us looking at problems though and saying, okay, well, this is a problem, I don't know what to do. Let's figure out ways to make things better. Let's figure out ways to work. Let's figure out ways to get better. One of the ways we get better is let's go become the best real estate agent possible. Let's go educate ourselves on 1031s. Let's educate ourselves on some of the things we talked about today. And let's become really a real estate advisor, not just a realtor, but an advisor to our clients. Let's advise them on reasons why they should get in the market right now, or why they should sell their home right now, or whatever the case may be. Let's go become the best real estate advisor we can possibly be and go help our clients achieve their goal of buying and selling homes. Perhaps we have clients that want to get into investment properties. Let's go figure out ways to help them do that. Let's go learn about cap rates and what makes sense financially on how much people may have to put into homes to get them rent ready, and what rents are in the area, and what a 1031 exchange is. Let's spend the time to get better. And I promise you, if we spend every day getting just a little bit better, we will succeed in any market. So appreciate you all being on. Appreciate everybody taking the time. I hope this was helpful. If you need copies of any of these slides, let me know. Give me a call, shoot me a text, send me an email. That's all we've got for today. I appreciate you all being on. Again, sign up for the trainings. Lots of good training coming up. That's all we've got for today, though. Thank you all for being on, and we will see you all soon.